All right, welcome back, everybody. There's just a few of us here today. I like to see our diehard fans back in. So let's go over a little bit of what we talked about last time. Last week, we just kind of started the idea of how we were going to practically put to use a bunch of the concepts that we started talking about, how we might actually start choosing assets and what's going to fit into the right places. So we talked about lateral integration and how we might choose some securities for that, using the basis of sort of a balanced fund, sort of middle of the ground, really easy to work with idea. Things like cash and cash equivalents, super short-term bonds, things like that that are not aggressive, things that can be liquidated very quickly for little or no loss, really liquid cash assets. We moved into stage 2 where we started talking about longer term debts, index funds, some other fund securities like that, things that would suffer a little bit more loss if we liquidated them, but gave us a little bit of growth, potential for reinvesting dividends, interest, so we can have a little bit more longer term horizon with that. And we have a couple examples of things that we might use within that. In stage 3, we talked about how that's our most aggressive, growth-oriented piece of a balanced portfolio. This is where we're really looking to push for those long-term gains, let many, many years give us those average returns that we see in historical data. So this is where we're really looking for lots of time, lots of data that we can put together and have push us higher. That's our growth-oriented assets, stock funds, longer-term bonds, maybe a little bit, not too much of those, but sometimes if we're in, say, for example, we're in a high interest rate environment and we have those longer-term bonds, if rates start to fall, we can actually see a decent amount of capital appreciation from that. Junk bonds too, and speculative investments like individual stocks, new sectors, and that sort of thing. We got into the basics of vertical integration and how we would diversify, how really the first level takes care of any unsystematic risks for us, gets rid of those company risks, those country risks, sector risks, and stuff like that, and how as we move up, as our positions get smaller, they get more targeted, they do more specific things, and maybe just do some new strategies that we're looking to take advantage of. So with that first level, like I mentioned, we're just trying to participate in the overall market. We're just trying to feel that trend, see the same as the market performance, really low unsystematic risk, super diversified, lots of individual holdings within the funds, and low cost, hopefully, so that we're biasing our portfolio towards a lower cost overall. Even if we have some more expensive funds later on, we hope that these will just bring our averages down so we're not paying too much for general market trends. Level 2 in the midsection, we're just hoping to get some more targeted things. Maybe we're looking for some sector funds, maybe a little bit enhanced large cap, small cap, mid cap, things like that that are just a little bit more particular, but we're not paying huge fees in order to get these. Maybe higher yield bonds could sit in there, corporate, longer term. So if we're looking at stage 1 for our cash, we might think, okay, so we have our base that's with our super short-term government bonds, and maybe we'll get a short-term corporate bond fund in there or something like that. And then when we get to level 3 at the very top, that's where we're looking to take higher risk in terms of the actual section that we're in. So if we're talking about bonds, these might be slightly lower credit rating, not low, but just a little bit lower, or maybe it's actively managed and we think we can get something out of that. But that's where we're really going to look for that management experience to hopefully give us a little bit of extra. We want to set our base with just participating, paying low costs, getting what's out there in the market, and then we can sprinkle a little bit of this active management on there in the hopes that the tenured management experience that we see from the fund maybe can give us a little bit of extra. But if it doesn't, it's not really a drag to our overall portfolio. That's what we really want to prevent. We want to prevent a situation where we have so much active management and there just happens to be a really bad time frame for active management and it really drags us down, because that can happen. There are things that we don't expect in the market that can happen that can really pull down those active strategies. So this is where we keep those allocations really small, because like I said, if they fail or they don't go in the direction that we want them to, we want the overall impact to be really small. So we're talking about 2, 3, maybe 5% positions, really small, that just are not really giving us any extra risk. And then we took a look at this chart to just kind of give us an idea of what we should be expecting over the longer term, and how if you zoom into these shorter time frames, the investments that over the long term would give you the best returns, can give you some of the most mediocre or downright negative returns in those shorter time periods. So it's just really reinforcing that idea of letting time do the work with growth assets. And then when we don't need that to happen, using stable assets so we're not at risk for those short time periods where the markets crash, like in 2008 or any of these other periods of time where there's been strongly negative returns. So today what we're going to do is we're going to start really implementing this lateral and vertical integration. And what we're going to do is we're actually going to start building a sample portfolio. So we're going to keep it really simple. We're not going to get complicated. We're just going to make this a really easy to understand, sort of do one thing for each section sort of idea. We're going to go through lateral integration, and then we're going to go through vertical integration. I'm going to show you basically how you can take these ideas that we've talked about and how that actually creates a portfolio. So again, we really want to remember visually how we're dealing with this. We're dealing with our cash needs first, and then we're dealing with a little bit of conservative growth, and then we're getting to more aggressive growth. And then we're diversifying, staying big, broad exposure. You can kind of think of this as how many different things would be included in this fund. When we get to the bottom, it's going to be a lot more stuff in there and bigger positions. And as we move up, it gets more targeted and the position gets smaller. So just remember that visually, and kind of how that ends up looking is when we go to each stage, we can think of it, each of it broken into these different sections. So really, this ends up being a visual representation of what the portfolio looks like if you're just not thinking about the individual funds, but this is how that's going to be represented. You're going to have that diversification in each stage. So we're going to start with a 3-fund portfolio. We're going to start super simple, 1 fund for each stage, and each one will correspond to a stage of lateral integration. And then we'll move forward and we'll start choosing other funds to put on top of them to further diversify and get those other things that we talk about. So we're going to start with a $100,000 balanced portfolio. The dollar amount doesn't really matter, but we're just going to say this is our balanced portfolio. We're constructing a simple balanced portfolio from the ground up and using everything that we talked about. So it'll be roughly 60% equities, 40% bonds. I think when I ran the report, it really was closer to 55-45, but anywhere in that 50-50 to 60-40 range is kind of where I'm expecting to land with a balanced portfolio. And we're going to assume that this investor has some current cash needs. So there's some need to distribute, likely with required minimum distributions or some kind of easy to wrap your head around concept. But they also are expecting that long-term growth. So we kind of want the best of everything in this portfolio. And we want to make sure that, we're just seeing all of that in there. So we're going to start with that 3-fund portfolio, and it's going to start looking like this. Now you'll recognize at least 2 of these from conversations that we've had previously. We have SGOV, VOO, and IWI. So each of these are representing a different stage. We'll get into what they are in just a second, but just remember, we're looking for our cash needs here, our short-term objectives, where we're looking for little volatility, maybe a little bit of yield, and then we move over to the middle, broad market, really easy, low cost growth and things like that. And then we move to stage 3, we're looking for much more volatile, bigger long-term prospects and everything like that. So let's get into what each of these components actually are now. So the first one, SGOV, is a 0 to 3 month treasury bond ETF. And so the reason that we're choosing this, again, remember what it's for. That stage 1 is those current cash needs. It's for right now. Where are those dollars that if I needed them right now, where is that going to come from? It's going to come from this fund. And the reason for that is because with these 0 to 3 month treasury bonds, you're not looking at a whole lot of interest rate volatility. If interest rates start flying up to the sky, yes, you'll see a little bit of depreciation in the value of this fund, but it's going to be so minimal because the remaining maturity of these bonds is so short. The idea is because the maturity is so much shorter, it's not that much of a drag for somebody to hold on to it for a month or 2 and then go back into the open market and buy another bond with a better yield. They're not stuck for a year. They're not stuck for 3 years, 5 years, 10 years. They're just stuck for a month or 2, and then the bond will mature and we can go back into the market and increase our yields. So the expense ratio on this is pretty low. It's not the lowest of any fund, but it's solidly low. Anything under 10 I really like, just because that's pretty inexpensive, and pretty much any yield knocks that out. So this fund invests at least 90% of its assets in US Treasury securities that have a remaining maturity of less than or equal to 3 months, for the reasons I mentioned just a second ago. The standard deviation on this over the last 3 years is about 0.63%. That's a really, really minimal. That's almost no motion in terms of volatility. That's basically flat. And the effective duration, as you can see of this, is 1/10 of a year. It's not very long at all. It's just a very short period of time. And so that's really keeping our interest rate risk low. So no matter what happens in the market, really, this is not going to move that much. There's not going to be very much volatility, and we can very quickly get to our assets. Moving on to stage 2, we have VOO, which is Vanguard's S&P 500 ETF. Now, we talked about this a little bit before. You could interchange a total market ETF or an S&P ETF or whatever index you really want to use. But for the most part, these big indices, these big large cap growth funds are going to be very similar. So I like to put S&P 500 in there because it's something that people can recognize. They kind of know what you're looking at versus a total market. You know, that's also pretty easy to understand, but S&P 500 is a recognition at that point. And when you have performance that is almost identical, it doesn't really matter too much which you pick. For me, I just like to bias towards low cost. And then again, here is just for that recognition. So the expense ratio is only 0.03%, which again, if you look at the historical performance of a fund like this, even though it's a growth, even the yield on the stocks in here will knock out that expense ratio, no problem, and you will not even notice that it's there. So the investment seeks to track the performance of the Standard & Poor's 500 index that measures the investment return of large capitalization stocks, because that's just your 500 biggest market capitalization. You know the deal, that's the most standard index that everybody looks at. And the standard deviation for something like this is 17.5 over the last 3 years. I would say for stage 2, depending on your risk needs, anywhere from, I don't know, 12 to 18, 19, 20% standard deviation would be totally acceptable. Something like value funds or anything like that could also fit in here. But we're just putting this at the bottom so we get that base sort of just stock market return that whenever you hear, oh my God, the S&P is up by 1% today, you know that section of your portfolio is doing the same.
Standard deviation, does that mean that your investment value can go up or down 18%?
Pretty much. So what standard deviation really means, and we'll get into the depths of it in later, but the quick explanation is basically if you have an averaged measured return over the last however long, you say it's been doing 10% a year for whatever. If you have a standard deviation of 17, that means it's pretty likely that within that year, you'll see it go 17% above that or 17% below that. So if you're averaging 10% a year and you have a 10 standard deviation, it's likely that your returns will be anywhere from 0 to 20. And the one standard deviation, which is what this measurement is like a 67% probability. 2 is, I think, 90 something, and then 3 is like 90, 95 plus. So it's really just kind of like, probably this is where your returns are going to sit in, but there's no guarantees, obviously. And so for the final stage, on stage 3, which is our most aggressive section where we're really trying to feel the most growth, the most volatility, and we're going to sit on this for a long time, is IWI, which is iShares Russell Top 200 Growth ETF. And it's another one of these index funds. Again, all of these are super easy. They're not trying to do too much, just index funds. But this investment seeks to track the investment results of the Russell Top 200 Growth Index, which measures the performance of the largest capitalization growth sector of the US equity market. So that's those top 200 growth stocks. And you'll notice that the expense ratio is a little bit higher because it's not one of those funds that everybody's got a copy of. With S&P, at this point, you basically have to fight for the lowest cost because everybody and their mother has an S&P 500 fund. So why would you ever pick one that charges more than the other one? There's just not any reason to. But with these, it's getting a little bit more specific, but still relatively inexpensive at only 0.2%. And the standard deviation on this, you could see, is a decent amount higher than the S&P 500, which again is why we're keeping this in that stage 3, because that volatility is higher and we don't want to be reaching our hand into this pot for any liquidity. So theoretically, all the needs for diversification in terms of the individual holdings inside of the funds is provided for. If you were to look at a Morningstar report on this, it would have thousands of, or maybe not thousands, but it would have a decent amount, several hundred stocks in it that brings our individual company risk so close to zero that that's not really too much of a concern. You could stop here if you wanted to. You could theoretically say my cash needs are met, my intermediate term growth needs are met, and my long-term growth needs are met. And if I wanted to, this could do what I need it to. It would be a cheap portfolio. You wouldn't have too much hands-on stuff to do, and you could just let it ride. As long as you're good at managing that and you can sit through that volatility, you're great. So a DIY hands-off investor might be satisfied here. But having more funds in the portfolio of different types of assets, of different sectors, it just gives us more control. And that's not necessarily to say that we're going to create more out of it. We're not going to get better returns, but it gives us this ability to be agile. We can be nimble. So if we have a situation where maybe a cash need did just arise, and maybe a sector has performed surprisingly well over the last while everything else has been dumping. It's possible. It's not super likely, but there's always that occasion where a certain fund might be doing just extremely well and you happen to need to refill your cash. You can take advantage of that and you can push it over and you can let everything else recover. So it's just giving a little bit more of that hands-on control and just being able to pick and choose a little bit is nice for the situation where an opportunity presents itself. I'm not going to kid myself and think that I can make some extra returns by picking these different sectors at the perfect time. But having the control where if an opportunity arises and I want to take advantage of it is pretty important. So as the portfolio manager, because remember, if you're doing this, that's what you are. You are your own portfolio manager. You are your own advisor. You've got to act prudently for your own interests and make sure that you're doing the right thing for yourself as you are your own client. We desire the ability to take advantage of buying opportunities and just rotating between positions for reasons mentioned just a minute ago. So we'll go a little bit further and we'll put in one more layer on top of these funds. So we've still got our 3 core funds, the iShares 0 to 3 month treasuries, the Vanguard S&P 500, and the iShares Growth. But now we're going to add one more layer. And remember, as we're moving on with our positions, these are going to be a little bit smaller. They might be a little bit higher cost. They might be a little bit more targeted, or just have a little bit more specific of an idea of what we're trying to accomplish here. So let's get into what each of these are. So the first one, adding to our stage 1, is PIMCO's Enhanced Low Duration Active ETF. So this is an actively managed fund, and we're getting a little bit more expensive here. And what I will say is, while we do like to bias stock fund costs really far down, it seems to be that in the bond market is where we tend to benefit from a little bit of management, because it's not so much about just predicting what the randomness of the stock market's going to do tomorrow, but it's more about strategically, really allocating that risk properly and making sure that you're taking advantage of yield when you can, and not overextending yourself to duration risk like a lot of asset allocation funds will do. So this one's a little bit more expensive at 0.51%. But again, we're paying for that management fee. We're paying for that experience that they have and the historical performance that they have. So this investment seeks total return, which just basically means interest and capital gains. We're in for all of it. We just want to see the best return that we can possibly get. But it's consistent with preservation of capital. So at the same time of wanting total return, wanting growth, wanting yield, we're also making sure that we're staying in line with preserving the assets that exist in the fund. We're not looking to take a whole bunch of risk, but we're looking to get what we can for the level of risk that matches capital preservation. So at least 80% of its assets go into a diversified portfolio of fixed income instruments of varying maturities. But you can tell that based on the name and the duration that we have, it's a low duration. They're biasing towards short-term funds so that we can make sure that our risk isn't too incredibly high. So you can see the standard deviation on a fund like this is only 2.33. That's a little bit higher than our other bond fund, but in the grand scheme of things, a 2.5% standard deviation is still not that you know, it's not that ridiculous. It doesn't put us at such a position where our assets are really, you know, they're not at risk too strongly. And our effective duration is just over 1.5 years. Now, again, that means that if those interest rates start to rise, there will be a little bit of a dent in the value of our bond funds, but it's not so high that, again, if interest rates go up by 1 or 2%, that our bond holdings fall by 20%. That's really what we want to avoid. We just want to avoid situations like that. So again, this is one of those things where we keep it in that first stage. We're just looking to get some more yield. We're really just trying to enhance our little cash position a little bit more and generate some yield that we can reinvest back in. Now, moving on to stage 2, remember this is going on top of our S&P 500 fund. This is Schwab's US Dividend Equity ETF. So pretty much what this is doing is it's another index fund. It's just looking at the Dow Jones US Dividend 100 Index, which is an index of a bunch of dividend paying stocks looking for some yield. And I think the yield kind of rotates between 1.5% and 2% right now, something like that. That's just a little bit of dividend that you get on top of the growth aspects of an equity fund. So again, we're looking for that intermediate term time horizon, a little bit of volatility, but throwing in a little bit of yield to give us the potential where if we see some market corrections or just generally we get some of those yields shooting off that we can reinvest back in for that longer term growth. And you can see the standard deviation on this for the last 3 years is a little bit lower than the S&P 500, not by that much, but by a little bit. If you remember, that one was like 17.52 or something like that, and this one's closer to 15.8. So you've got a little bit less volatility, plus you got a little bit of yield. It's a nice middle ground. So if you don't feel like you want to go completely risk on in the S&P 500, a fund like this is a pretty good option to be a little bit more conservative, but still be in the same ballpark generally. Moving on to stage 3 is Vanguard's FTSE All World except United States US ETF, or except United States ETF. So this is pretty much just it's a global fund. It's supposed to get all the different countries except for the US. And this is what I tend to use for my internationals. And again, we've had this conversation a couple times, but the reasons why you might use internationals is one, because their values can be a little bit lower. They can be a little bit cheaper for the dividends that you're getting, but also at the same time, other country returns, stock market returns, tend to just behave slightly differently. Over the long term, there's a decent amount of correlation. They move in generally the same direction, which is what we want. But in the shorter term, when we go into these smaller time frames, we see less correlation. We see them tend to move in opposite directions or just go up on different days. And the reason that that works is pretty much if over the long term you have a high correlation, you know that all of these assets are going to generally move upwards, grow your portfolio value, good stuff. But in the short term, if we have times where the US does particularly bad, but the rest of the world's doing all right, it actually reduces that short-term volatility by just a little bit, because you might have good performing assets in the other countries versus the US dragging behind. So we can see that the US positions might drop a bit, but maybe the other countries will, you know, pad a little bit of that loss by having their own good days. And if hopefully everything decently moves upward in the long term, it's not that we're giving up a whole lot of return for that short-term volatility padding. And you can see that these are pretty volatile as well. So this is closer to 16.91% standard deviation over the last 3 years. And yeah, so you're just seeing a decent amount of volatility, not quite the same growth prospects as the US market generally tends to have. But again, you want those slightly different returns so that the short-term volatility is lower, but the long-term is still on track. So now that we've done that, we're sitting at a point where we have this new layer of diversification. So what are a couple of the benefits from that? Well, first of all, we have that more hands-on management of our short-term bonds with a little bit of potential for higher yields. Maybe they're able to capture some better gains, or they just find an opportunity that we're not looking for because that's not what we're trying to do. We get a little bit of extra yield from the dividend stocks for consistent reinvesting during market volatility. So we have times of big swings up and down, maybe with the election coming up, we have those dividends shooting off that we can put back in so that if prices tend to drop, to a point that's discounted, or however you want to look at that, we can get back in and potentially ride that wave back up over the long term. And then there's the potential for those non-correlated returns that I was just talking about with securities based outside of the US. So having those slightly different returns, again, where if short term they're less correlated, brings our risk down, but over the long term, they're decently correlated, so our returns generally are positive going forward. And so again, if we wanted to, we could stop here and it would be a fine portfolio. It would work out decently well. You'd have pretty all right returns. Your risk profile would be decent. And some people might, maybe that's for you. Maybe the 3-fund portfolio is for you. Maybe the 6-fund portfolio is for you. But we're going to go one step further. And this final step is by no means like it's not the end all be all. 9 funds is not a really, advanced portfolio. It's decently sized, but it's not, it's nothing crazy. We generally are using between 12 and 15 funds per portfolio, maybe a couple more depending on the situation. But this kind of puts us at a point where we can see all of the different moving pieces together and working to create a portfolio. So now we have our final layer that we're adding on. And now we're getting to our smallest positions where, remember, we're reducing the risk of these positions not working out by having them be smaller, and they get more targeted and they do more interesting things. So stage 1, we have our 0 to 3 month treasuries, our active short term, and then we have this fund VRP we'll talk about. Stage 2, we have our S&P, some dividend stocks, and then SHYG that we'll talk about. Stage 3, we have our top 200 growth, our internationals, and then this XSMO that we'll talk about in just a moment. So VRP. VRP is Invesco's variable rate preferred ETF. And pretty much what this is doing is it's looking to invest in preferred stocks, some other hybrid securities like convertible bonds and things like that, and look for opportunities to generate a little bit of extra yield while still feeling a little bit of that growth potential from those convertible stocks and or convertible bonds, preferred stocks and stuff like that, because they do have appreciation potential, but they tend to be a little bit more focused on yield. So the expense ratio of a fund like this is closer to 0.5. You notice that our stage 1, other than our short-term treasuries, gets a little bit expensive because that's what the managers are able to charge for their performance. And this tracks the investment results of the ICE variable rate preferred and hybrid securities index, an index designed to track performance of floating and variable rate preferred stock, as well as certain types of hybrid securities. So basically the stuff I just mentioned. You can see the standard deviation on this is getting decently higher, which is again another reason why it's a smaller portion of our short-term assets. It's getting closer to 8, which is a decent amount of volatility, but on a small level. Remember, we're making sure this doesn't impact our cash too much. It's just there to enhance yields a little bit and maybe kick off a little bit of dividend payments that we can put back into our short-term treasuries, just so that we have a little bit more to work with. Effective duration on something like this is closer to 2.29 years, which is the highest of all of the positions in here. But notice that none of the durations have ever crossed 3 years. We really don't want to be crossing the 3-year mark when we're talking about short-term bonds, we're talking about cash, because again, this is where that interest rate sensitivity is going to come out. This is where if the rates start to fly upward, that's what's going to hurt us. As a high duration number is what's going to drag down the bonds. So we're going to make sure that we keep that decently short, especially for cash positions, so that we're not putting that at risk. Next in the stage 2 will be SHYG, which is iShares 0 to 5 year high yield corporate bond ETF. So putting this in stage 2 is a little bit interesting because it's not quite a growth asset. It has a little bit of growth prospects, but it's mostly looking to get higher yield at higher default risk. So we're putting ourselves a little bit at risk that some of these bonds may not work out. But again, this is we're following an index, we're nicely diversified, so we're pushing that risk out onto multiple bonds. But we are increasing our yield a little bit and giving us something that, again, we could take these yields and plug them into our stock funds or plug them into our cash funds. Just do something else with them. So the expense ratio of this is about 30 basis points, about 1/3%, a little bit less. And it tracks the results of the Market iBoxx USD liquid high yield 0 to 5 index composed of high yield corporate bonds with remaining maturities of less than 5 years. And a standard deviation for the last 3 years was closer to 6.26, actually less than the previous fund we looked at, but that default risk can add some extra risk that we're not necessarily accounting for, that we can't stop that. If somebody defaults on their bond because they're not a good company, nothing we can really do about that, which is again why we move this into a position where we have a little bit more time, so that if that is an effect that we feel on the bond fund that drags us down, we have a little bit more time for the other yields to kick in and bring us back up. Again, low duration. We just don't really like high duration bond funds because once a long-term bond fund goes down in value, it takes a lot for it to come back. They really struggle at recovery. So again, 2.15 effective duration. Yes, they are a little bit more sensitive because they're lower credit quality, but we're getting higher yields to compensate for that. And then lastly, for this layer, we have XSMO, which is Invesco's S&P Small Cap Momentum ETF. So this is one of those ones that's kind of like a factor fund. It's taking an index, but it's adding some extra constraints to get an idea of how they think is going to be the better move over time. It's got an expense ratio of about 0.39%, and it seeks to track the investment results of the S&P Small Cap 600 Momentum Index, which is composed of constituents of the S&P Small Cap 600 Index that have the highest momentum score. However that's calculated, whatever it is that they're doing to determine a momentum score, they're applying that to the Small Cap 600 Index and taking those out of that, some top whatever number of that, that's what they're going to use. And you'll notice that again, I think it's the highest standard deviation in the entire fund or entire portfolio at 23.43. So we're using that super long term. We want to wait it out. We want to let that go and grow as much as possible over the long term. So we get to the end of this, and now we've created our portfolio. We've finished our portfolio construction. It's a simple sample, though. Don't think that this is going to be the end-all, be-all portfolio. You're not just going to take this, apply it to your needs, and it's perfect. It's not a specific recommendation. If your needs are more complex or your assets are really substantial, you might want to add some more levels of diversification. You might want to do more with it. And you might even want more stages of lateral integration. All of this that we talk about is really just like a guideline to get you started. It's possible that you might be looking at a portfolio where you go, I need to plan for this year's distributions. I need to plan for this college cost coming up. I need to plan for this retirement need. Like you might have more stages of lateral integration that you want to use. You could have 5 or 6 or 10. Maybe you have different beneficiaries in mind. You really want to take your needs into consideration and think, how specific do I want to get with this? How much does it matter how specific I'm getting and what I'm doing with my assets? And this allocation is based on a balanced investor. Remember that too. This is not for every risk level. This is for that middle of the road person that's just looking for a little bit of everything. They have some cash needs, they need to take out some money, or they just want to park it for investing opportunities. They want to see some growth over the long term. They want to see these assets grow. They want to see this account start moving up in value. And you might be more or less aggressive than this investor. This is not you. You are the only person that is you, and it's really important to look at your needs and make sure that everything that you're doing fits within that. So again, these securities are not specific recommendations. You can use them if you want to. All of the different funds in here you can use, but they might not be exactly what you're looking for. They're just trying to serve as generic examples. And what I will say, though, is I did choose all of these from portfolios that I build. So everything you saw up here is things that are in client portfolios right now today. These are all funds that I use. These are things that I like, that I've compared against a lot of different other funds. Not that they're the best in their class or they're perfect or they're going to beat out every other option. I can't say that, and I don't have that sort of confidence. But they are good at what they're doing, and what they set out to do, they do well. They perform well. They're generally lower cost than other funds in their category. So you may consider them if they fit your needs.
Are you using less managed mutual funds and going towards all exchange traded funds, or are you still using some managed?
Yeah, so for mutual funds, the only time that we're really using those right now is for two things. One is for systematic withdrawal plans. So you can't, with a systematic withdrawal plan, basically what you're saying is, I want to take money out of this fund on a regular interval every single month or year or whatever it is, pay out RMDs, pay out a regular distribution, and you can only do that through a mutual fund. You can't actually do that through an ETF. And it's because with the ETF, you have to go sell the shares on the open market, and it's just a little bit different of a process. So if we're setting up automatic distributions, we'll use a mutual fund called FUMBX, which is a short-term bond fund. And then also there are some better money market funds or mutual funds. You might see some other municipal bond funds would be a time to use those. Or if somebody's holding a legacy position like a T Rowe price capital appreciation, you might hold on to that just because of how well it's done in the past. You can't add to it. You can't buy it as a new investor. But if you're holding on to that, if you've got really good performing funds that you don't have any reason to get rid of, you don't have to. You can swap them out for other stuff. But generally, we're going for ETFs almost all the time because of liquidity reasons. It's really easy to get to those ETFs. You sell them, it's in the account the same day, cash settles in a day, it's right there. Versus with the mutual fund, you got to wait until the end of the day to see what you sold for, but you do get, your dollars out. But yeah, mutual funds are just they're just less nimble versions of the same asset. So unless they're doing something in specific, like being able to fund a systematic withdrawal plan or something else that I can't find anywhere else, there's not too much of a reason to use it generally. But again, if there's something in particular, we're totally happy to use those.
And where your clients have this package.
Yeah.
How would you rebalance or meet with the client?
So rebalancing is an interesting consideration. Straight up rebalancing, like just saying we're going to blindly rebalance across the board, maybe once or twice a year or something like that would be when I'd consider that. I like to do a little bit more tactical rebalances, kind of paying closer attention to what's going on generally in the economy and what the positions are doing themselves, because I don't necessarily want to just cut the performance short of something that's going to do really well. Like, let's just say, for example, utilities was just really raging for a while there. Would it have been the most prudent thing to say, oh, it got over 5%, it's at 5.01, get that out of here and now move it to the other thing? It might be better to let that ride for a little bit. So I think if you're considering it, maybe evaluate monthly or quarterly, but it's not necessarily that I would be making a trade. I would want to be very aware of what I'm looking at, and also keeping up on how it changes the risk as well, because that's going to be another one of the main things. You might be in a position where one fund drops from 5% of the portfolio to 3%, and one raises from 5 to 7%, but the risk level is still the same, and it's still giving you the same objective. It's still giving you the same thing in your portfolio. So you might not want to just rebalance for no reason. And again, you don't want to cut off that good performance. So I think quarterly is kind of the most reasonable place to sit in, where it's regular, but it's not so regular that you're going to start disrupting the investment plan. That's kind of where I would just generally sit at. Yeah. Yeah. So the more specific, the smaller positions, the more susceptible to unsystematic risk. Those are the ones I'm going to look at first. Total market, S&P, that can get overweighted. I'm happy with that because that's just kind of general stock market stuff. You're not going to get much different than that. So looking at those more specific sector funds, or if long-term bonds decided interest rates crash and now they're up by 15%, I might want to capture that. But yeah, it's kind of, specific to the sector or what's happening economically, for sure.
And consider that the client's getting older, and say that we have to run to the sideline, get scared, but it was recap instead of this not that spot, making push it a little bit almost as we get older, get the money. But that's what we get out of it. from portfolio. If the market crashes, that's when you should get a call. Guess what? You're down 5%. The white thing, they're down 50%. Now I'm going to find out. I'll look at your statements. They're not. You can't guarantee they'll adjust or not, but there's so much to happen.
Yeah. So the next question is sort of looking at position sizing. How are we going to size these? Well, I know we said bigger for the bottom layers, and it's just kind of want to remember what that pyramid is representing. We want to bias towards those low-cost, broad investments because, again, we don't want to expose ourselves to specific risks. We don't want to have 10% of S&P and then 30% in utilities, and now suddenly, if utilities decides to do something weird, our entire portfolio is beholden to that. So the more specific or less diversified and more expensive a position is, the smaller we want it to be. If I'm paying 2.5% for some reason, for some manager that's doing the most genius thing in my portfolio, I still want that to be a smaller portion because I don't want that fee to drag the entire performance of my portfolio. Because often what happens is you might have a growth fund that charges 1%, 0.2, and they do really well for a stretch of 5 years. And then you just hit some sort of economy where it just doesn't work out well for them. And then if you have okay returns minus 1% management fee, that really starts to drag you down. And it's not tailored to your risk. It's not an advisor that's looking out for you. They're just working for their fund. So you kind of got to think about, like, if I'm paying that fee, what do I want to be paying it for? Do I really just want to be paying it for a growth fund that may or may not do well? Or do I want to pay for a more tailored service that's closer to what I need that the advisor knows is the correct risk level for me? So kind of a super simple basic allocation guideline. Again, this is not an end-all be-all. It's just a place to start. Tweak these numbers when you throw it down on your portfolio. But you might start with the first stage being 40% of your portfolio, the second stage being another 40% of your portfolio, and the third stage being 20% of your portfolio. And remember that 40% is not entirely in those short-term treasuries. That's in those variable rate things and those higher yield. Just these are spread out amongst different allocations. And then you can see when we get to the vertical integration, the diversification layer, we'll bias towards that first layer on the bottom, the 45%. We really want to get those low-cost investments. Then as we move up, slightly higher cost, but not expensive, we'll get another 40. And then we get to the very top, that very top layer, super small allocations. So if we want to see that visually represented, we'll look at a graph like this, where with our $100,000 balanced portfolio, we'll see in our first two stages that are the same size, we'll see that bottom layer will be $18,000. So that's, remember, that's $18,000 in our standard, or in our S&P 500 fund, 18,000 in our SGOV fund, 16 in our dividend fund, 16 in our active low duration, and just kind of place those funds visually where they are going. And here we can take a look at what the balanced portfolio ends up looking like. So this kind of gives you an overview of what this ends up being. We see, again, in the SGOV, VOO, those biggest allocations, those are the cheap. VOO is only 3 basis points, SGOV is only 9. So remembering that that's really biasing our cost down. And you can see that where even when we have those more expensive positions, like in stage 1, you remember LDUR and VRP were both like 0.5%. Even though we have that, because we generally bias towards the low cost, our average expense ratio on this portfolio was only 20 basis points. And for me, I like to sit within that range of 15 to 25. That's where I like to be. It's 0.25% or less. It's not dragging too much. Even if you're just collecting yields off of short-term bonds, that's still fine because that fee is getting paid for. And then you'll notice that the standard deviation of a portfolio like this is approximately 9.87. And if you kind of think back to using the S&P 500 as a benchmark, think, okay, that S&P 500 has a standard deviation of about 17.5, almost 18. And our portfolio is just a little bit over half that volatility. So for that balanced investor, for that moderate person, this is sitting right in that range that we want it to be at. We're getting all of our needs met with our short term, with our growth, with our long-term growth, and we're right in that risk level that we want to be sitting at. So again, you can tweak these positions, you can split them up more, you can go and take the internationals and you can split it up, maybe have more emerging markets, something like that. You could split up the growth, you could go for a tech fund, you can add utilities funds in any section here that makes sense as long as you're aligning the properties of those investments with where you're putting it. So you can really do a lot to improve portfolios like this. Yes.
Is it a target range for standard deviations?
So generally for balanced, probably anywhere from like an 8 to an 11, maybe somewhere in that range. Sort of generally, growth would be closer to from 12 to 15. Maximum growth would probably be 15 plus. Income portfolios, I probably want to keep closer to the 5 to 7 range, something like that. But yeah, we just, for anything balanced and under, I want single digits for sure. I don't want to be pushing up on 11, 12, 13%. And of course, it kind of depends on exactly how conservative you are, because you could take this portfolio and you say, 9.87 is a little conservative for me. Let me just bring down the LDUR allocation, whatever, and just crank up the S&P. And you could push it to 11, 12, 13% standard deviation if that's more comfortable for you. Or you could do the opposite. You could even say, I don't care so much about these super long-term growth prospects. Let's take those and just distribute those over there. And you might bring it closer to a 7 or an 8. So there's a lot that you can do with a portfolio like this, even if you just start here and think, this isn't quite what I need, but I can tweak this to get to the right place.
There is for that's like driving a car. We don't think about this going in there, but people can go back. They don't get all that like I had fine. So how long would you serve at a product? I gave it about 80. Then we would touch into the stocks. They go, oh, okay, fine. You do this, they involve market fashion, also use some, we have storage, and live off of quite a few years. Unless
Yeah.
Or we have different types of.
Mhm.
Is that term portfolio go across types of accounts or within types of?
So it kind of can do both. Generally, when we're like in this example, we're talking about a retirement account, just maybe like a 401k or a Roth IRA. But realistically, we're talking about your whole collection of assets, talking about everything that you've got and what we're going to do with it. Generally, I like to break down the use of all your different assets into each specific account. So if you're sitting on a 401k and an IRA and a Roth, you might think, well, this IRA is going to be paying out distributions, so let's make it a little bit more conservative. So is the 401k. We'll align those. And then you think, well, the Roth, I don't have to take anything out of. It has the best tax benefits for growth. Let's just crank up the risk on that to completely aggressive. So you have your other two portfolios that are keeping you somewhat stable, and then you allow that to be your long-term growth. You can kind of think of that as if you really wanted to, you could say if you have a standard brokerage account, an IRA, and a Roth account, you could say the IRA is going to be my stage one because the money has to come out of there. So I'm going to take that as my cash. I have my standard brokerage account where I'm holding money that I don't really feel like I need to get to, but it would be nice for it to be accessible. Sure, make that your stage two. And then you've got your Roth IRA that has the best tax benefits for growth. Make that your stage three. So you can really just kind of, everything can be a piece of the overall picture, or you can split it into individual needs. Kind of depends on how you want to do it. There's a couple different ways that you can determine what each account is going to do. One, you can think of it as your entire big picture, or you can split down and go, 401k is for my kids. The standard brokerage is for me. The IRA is for my income needs. You can break them down to use cases. And I think that's probably, it's the easiest way to get an idea of exactly how you want to manage it. Because when you are given a use case, you kind of think, oh, well, now I kind of understand where I need to be sitting at for that to be successful. So that's a really good way to determine how you want to invest each account and how all of it's going to fit into the big picture.
So instead of harvesting some data, buying some stock, we're just going to ready. It's 2 years of and spread it out. Most stock.
Okay, so let's,
You heard it said it's a good practice to have like 3 to 6 months of money for an emergency.
yes.
Is that stage one, or is that a different set of money in a savings?
So I would consider that part of stage one.
Okay.
If we're looking at sort of your overall picture and we apply this concept to your overall picture, absolutely that's what that is. And we are generally on the way more conservative side than that number. 3 to 6 months is good. I like a year or two. And that's, again, whole picture, assuming all your investment assets. A lot of the times where if I'm doing required minimum distributions or some kind of regular distribution, I want to have at least a year's worth just tied up and ready to go at any point in time. Maybe a little bit extra volatility on the second or third year, but anywhere between 1 to 3 years for the overall everything when you've got big investment accounts and you've got cash needs is really important, especially when you get to a point of not generating income from employment. When you're generating income from employment, yeah, 3 to 6 months is good. It can sort of fill the gap between if you lose a job and need to get another one. But if we're talking about retirement, if we're talking about like end of life sort of stage, 3 to 6 months is not very long at all to figure out where you're going to start generating extra income or be able to pay for an expense. So it's really nice to have that really conservative, big chunk of change sitting there so that you can access it at any point in time. Yeah.
Right. All of us early did, but it is, could have elements an increase on longer here.
Yeah. So let's think about what we could do to actually make this portfolio better. I mean, there are a couple things that I mentioned before, but we could further diversify the income holdings. We've only got a couple funds in there. They're doing their job, but we could diversify a little bit more. We could get some longer term government bonds if we wanted to lock in rates for a longer time, or maybe you think that rates are just going to keep sliding and you want to take advantage of that. That could be an idea. You could get some investment grade corporate. We have the high yield in there for the higher yields and the higher risk, but you could also add some short-term investment grade corporate, those high rated companies that are still not going to be paying crazy interest rates, but they're decent. The only reason that right now I'm not even thinking about that too hard is because when you just compare the incredibly low risk of short-term treasuries to the slightly higher yields of investment grade corporate debt, you might as well take what is basically the best credit rating you could possibly get in the market, which is the US government, and still get 4.5%, 5% versus maybe 5.5%, 6% if you're lucky with investment grade corporate, where the high yield is paying closer to 6.5%, 7%. It's like, if I'm going to make that trade-off, I might as well really get something for it, even if I'm taking that extra risk. You could also add something like derivative income. That's a fund that I didn't show on here, but that I am using is something like JEPI, which is a fund where JP Morgan is investing in stocks in the S&P 500 and then selling options on those stocks in order to generate some extra yield. It does introduce some interesting risk characteristics, which is why I didn't bring it up here for this class today. And it is something you kind of have to manage very well and almost treat it more like an equity holding than an income holding because of the stock risk that it holds. But it is something that you could use to sweeten up your yields just a little bit and add some income that comes from a different place other than bonds. That's one of the things that I like to do with income holdings is I like to bias towards those short-term, low-cost bonds, all that good stuff, but then also just sprinkle in a bunch of different other sources of income things like derivative income funds, things like dividend funds, things like high yield bonds, or whatever different stuff you can think of that just give us a bunch of little positions that we can have that maybe have some potential for growth, but are going to spit off decent yields. So like these derivative income funds, the standard deviation on them is pretty high. We can actually look at these individual things on Morningstar in a second. Standard deviation is pretty high, but so is the yield. We're talking closer to 9.5% versus the 6, 5, 4 of the bond funds. But again, that risk goes up because of the underlying holdings and the way that the investment works. So we'll take a look at that in a minute. The other thing that we could do is we could add some more sector-specific, non-correlated investments in stage 2. We could add some cyclical sector funds, utilities, consumer staples, consumer discretionary, all those different sorts of things, technology, other defensive holdings, not just like defense stocks, but things that tend to weather economic upheaval a little bit stronger. Things like consumer staples have been doing pretty well because lots of inflation. I mean, everything's expensive. You go to the grocery store, it's ridiculous. So that's where you see that reflected. And if you're conscious of that, if you see that happening around you, you can expose yourself to that a little bit, expose yourself to the benefits of it, even if you don't feel so happy that you're supporting the people that are jacking up your egg prices. Maybe at least you get paid a little bit for having done so. So those are a couple of the different things that we could do with this portfolio to really juice it up, make it a little bit better. We're not going to increase returns by anything crazy, but we're giving ourselves opportunities to be nimble, to move around, and to just do more stuff with our portfolio. So a couple different things to remember about this. Each portfolio will take on a totally different form based on its purpose. Yes, there are lots of really good model portfolios out there that are built for different risk, but it's important that you understand how to connect that risk to what you're doing. Model portfolios can be good, they can be bad, but really what makes a model portfolio bad is when it doesn't match your risk tolerance. If you're put into a model portfolio by your advisor that's way too aggressive for you, it's not the model's fault, it's the advisor's fault for picking the wrong one. But it really just depends on what the purpose of the account is. Like we were just talking about a second ago, you can have very particular purposes. You can say that this one is my retirement income. This one is my growth for my beneficiaries. This one is to pay my tax bill, so I want all municipals in there. You can create a lot of different purposes for your accounts. And it's really important to get that purpose locked in early on, especially with taxable accounts, so that you don't end up in a situation where you have all of this taxable gain, but you want to do something else with it. That can be, that can be a point where it's like, now we have to take a long stretch of time and really start moving out of that. But it's really important to just nail down what you want to do with each portfolio and just understand what purpose it is, what kind of risk level we're looking to do, and then you can make really good educated decisions from that point forward. So a portfolio can be as simple or complex as you like, but regardless of how many funds you have, retain diversification. So that sounds a little interesting. It doesn't matter how many funds I have, but stay diversified. Yes, because you want to remember what is in those funds. There's a reason why we bias towards that inexpensive S&P 500 fund, because we're getting spread out across hundreds of different stocks, and we're not exposing ourselves to individual company risk or individual sector risk too much. That's why we want diversified things. That's why total market, maybe an equally weighted total market fund is up your alley. Something where you really are just getting tons of diversification across those internal assets, because we don't want to be at a position where we have this really good growth fund, but is it really a growth fund or is it a Tesla fund? That could give us some extra risk that we don't want to be exposed to. Bias your holdings towards low-cost investments. Fees can be a major detriment to performance, even with good performing funds. And like I mentioned before, it's not the best years that that's a problem. It's the most mediocre years where that's a problem. If you have sideways returns, if you have, we didn't really gain anything this year, maybe we made 1%, but my fee is 1.5%, I really lost 0.5%. For what reason? And again, if you're paying somebody to make sure that that risk level matches what you need, that might be worth paying for. That peace of mind might be worth the 0.5%. But if it's impersonal and it's just another fund that could be charging you next to nothing, it's hard to see where that benefit will come into play unless it's a really small, inconsequential piece of your portfolio that's not dragging you down. So again, just remember all those different things and how you put them together and how that's going to work your portfolio. So I'm going to pull up Morningstar really quick so that we can actually look at some of these individual funds in here. I think the allocation on this is a little bit off, so don't mind the numbers, but we've got all of our different funds here that we were looking at. So we can look at each of these individually and get a better idea of what they are. So let's start with SGOV. We can see here a lot of the quote page on Morningstar is really helpful. We have a couple resources for if you want to get Morningstar a little bit less expensively. There's like a library card that you can pay. It's like 30 or 40 bucks a year, and you can get Morningstar instead of paying the monthly fee for this like we do. But we've got a login for the class. So if you ever want to have me look up anything, feel free to always ask. But you can see some of the core characteristics of this fund just from here. You can see the expense ratio, like I mentioned before, which is relatively low at 0.09. You can see it's a US ultra short bond fund, and you can see that the yield is still sitting at a really decent 5%. When I was looking around at a bunch of the different bond funds of this category, this one happened to have the highest yield. And when I'm looking at 0 to 3 month treasuries, I know that they're all holding basically the same thing. So I'm going to pick the one that pays out the most with the low expense ratio, just because you're not too worried like, oh, they're doing something weird with a U.S. Treasury fund. They're buying U.S. Treasuries. It's not that odd. It's well rated by Morningstar with a silver medalist rating. Can read a bit more about what those are. And if we go to the risk, really? Yeah, I guess we can choose all that. Right. Okay, cool. It didn't want us to see standard deviation without confirming we were a human. But again, here you can see the portfolio risk score this is like a really easy numerical value that you can use to sort of judge how risky a fund is. And you can see that is all the way at like one of the lowest numbers you could possibly have at a risk rate of 1, which means it's one of the most conservative possible funds you could have ever. The risk for its category is low. The return for its category is nice. And you can see this is where I got that standard deviation number from for the 3 years. We can scoot it back to 5 years. And I think this fund has existed for 3 or 4 years, so it doesn't have that older data. But you can... Yeah. Oh, I've seen some as high as 60 or 70. Exactly. Exactly. That's why I like this fund so much. That's why I'm sure you've seen me recommend it several times, is because standard deviation is so low. The yield is strong. It's really doing this job really well. And I can kind of show pretty much how you would do something like that. You can also use this screener tool from Morningstar, which is really helpful. I'm always just looking at ETFs. So let's go to ETFs. We can pick what that is. We can pick the asset class. So maybe we're going to say, let's see, let's do Morningstar category. Like, oh my goodness. Okay, so I guess we can just search. Yeah, so you can customize all these different columns. You can figure all this different information that we'll learn a little bit more later, but we can look at all this different stuff and really get an idea of what we're looking for. So here, you can see that I just searched Treasury. We're looking at all these different funds. I can sort by the SEC 30-day yield, which is just kind of taking the last 30 days and expanding that into a year to see what that would perform like. And you can see the SGOV lands squarely on top. Nice low expense ratio. You've also got this one from Global, Goldman Sachs, SPDR. All of these are great. All of these are wonderful. I just picked the one at the top because it just was appealing. And we just like that fun. So again, this screener is awesome. Exactly. Like you can see right here, we got our 0.09, our 0.07, and immediately below that at under 5% yield are the ones with the higher expense ratio. So it's kind of just a direct,
Based on expenses.
yeah. Yeah, so those numbers that you'll see, the yield, because it's an actual payout from the fund, that's why you'll see the yield go down when the expense goes up, because it's taking that into account. It's like a net income sort of a thing. Mhm. Exactly. So that's a fund that we really like. Let's go back to VOO. Yeah, let's go ahead and do that.
Is Morningstar similar to what they have like at brokerage companies like Schwab?
Yes. Yeah, definitely. I just really like how Morningstar is laid out. I don't necessarily look at their research and stuff all that much. It's nice to know that they like a fund I'm using and then I can say, hey, Morningstar likes it. But I really like the way they lay out all the risk data and all this kind of stuff. And usually a lot of those places that are displaying that information are pulling it from Morningstar a lot of the time. A lot of the brokerages are actually just pulling their information from here. Okay, so yeah, here we've got VOO, our S&P fund at 0.03% expense ratio. Sure. Yeah. Sure. Yeah, so that would be something, yeah. But if we just look historically, like it just always seems to be the thing that performs like right at the top. It always is leading the pack because of those big companies. I mean, a lot of times because they have a lot of, support from the economy, from the government, all sorts of different things that are just those big companies, like, too big to fail. Like we don't want them to implode. So they just keep getting held up by valuations or consumers, all that kind of stuff. And yeah, it's interesting to see that just this fund or funds like this are just constantly performing really strong. Mhm. Yeah. Yeah, so speaking of equally weighted, here's an Invesco equal weight fund. And I'm curious, the yield is very similar. In fact, a little bit better. You can see it's a little bit more expensive. But what I'm curious about is if we go to the risk section. Yeah, so let's compare these. And you can see, obviously, VOO is the index. So you're not, versus anything is not really going to mean anything because it's the same. But interestingly enough, you could see the standard deviation on the equally weighted is actually higher by a tiny little amount. So that's probably because you're getting more of those smaller companies to be larger portions of this fund. So their volatility is stronger. You can see that the return is weaker. We've got a negative alpha, which we'll talk about more in depth later. Let's see if we go to something like a performance. I'm curious. Yeah, we can look at that in just a second. But yeah, you can see here that the index that we're comparing to, which is large mid, basically total market or S&P or something like that. You can see that this investment's actually lagging behind pretty decently. And the volatility has been, just as bad, but without all of the positive. Here we've got 11.62 where VOO was at 18. Sure. But the issue is then when you don't have all of that upward performance, it doesn't really make up for it. So in the long term, it ends up being kind of a lagger, which is really interesting. Let's see. Now let's look at the portfolio. Scroll down, we can see the top holdings. Yeah, and so here you can see a bunch of, you'll see some companies that are familiar. But because it's equally weighted and they're all very similar, you'll see a bunch of places that I've never heard of. So it's really interesting to see.
That's 25.
I think that's yeah, I don't know if they show all of the holdings. Yeah, equity holdings is 503. So I just don't think they show every single one. Yeah. Anyway, let's get back to our portfolio. Yeah, and then we can show possibly this PIMCO fund, which we can kind of see why, and again, this is one of those reasons why I was kind of saying, even though, yes, we can use corporate debt and all this different stuff, like if we just look at the yields, like remember, like, yeah, we're paying, 0.5%, so we're probably getting closer to 5.1 on this, but the yield on this is 4.6. And we compare that just to the SGOV fund that we just looked at that was still at like 5.03 or something like that. For 0.09% expense ratio, that one really kind of speaks. Now, this will have more growth aspects because it's got some longer term bonds in there than the 0 to 3 month. It's just got some other ways to generate return. But if you're simply focused on yield, it's still hard to recommend anything other than super short-term treasuries because they're just still paying such wonderful yields. If you wanted to lock that in on an intermediate term, possibly. But I remember last time we looked at that yield curve and it was still all over the place. It was really difficult to pin. So it's really interesting to see the difference in those returns. And then you'll also see that if I go to the risk, you'll see the same, the standard deviation is only 2.3, but that's still solidly higher than that 0.6 that we saw in the governments. And yeah, but we've got solidly low risk for the category. Return is average. And yeah, it does pretty well. It's pretty much getting the same return as its category, but at a lower risk level, which is only by maybe 2%, but it's still worth noting. So, okay, let's get back to the portfolio. And then we'll take a look at the high yield so you can kind of see the difference. And see here, we're getting that SEC yield of 6.94%. That's why I'm actually all right taking this fund, because it's got such a higher yield. Now, that does mean that if I go to the portfolio, we see that these bonds, while they're low duration, effective duration still 2.15, we can see that their average credit rating is a good amount lower. You can see this right here. We're dealing with basically junk bonds, bonds that if you were holding them individually would be a little scary to own at times. But over the long term, there's a lot of these companies that they just are in a situation where their credit rating has really dramatically fallen, but they still need to take out debt and some of them will survive. And it seems that if we go to the risk section here, again, the risk on this fund is below average compared to its category, which is why I would choose a fund like this, where really, again, we're not always expecting that we're going to do better than everybody else. I want to do as close to everybody else as possible with as little risk as I can take on. Because if I'm taking on less risk than they are, but I'm still returning close to the same, that technically means I'm doing better proportionally. And that's what I want to get. That's why we like funds like this, where the risk is still low. Let's see if we maybe bump it up to, if we go to the 5-year, it looks even better. And then 10 years, still good. Standard deviation below 6%, even on a 10-year basis. On a 5-year, it's a little bit more because just, within that last 5 years, we saw some bond volatility, but it's another one of those funds that I like. What else? What else? You can see what VRP does. VRP giving us 5.31% SEC yield. Not that much higher than the government bonds, but remember, we're also paying 0.5% for that. So really, we're getting closer to 6%. And that's with a risk that's not ridiculous, lower than its category, higher than some of those other investments. But again, we're getting that better yield. And we can see that it's actually performed decently well. I mean, we see it starting all the way down here at 10,000, gets up to 16. And in 2022, we saw it drop 9%, which in terms of all different types of assets that you could pick from, that's not too bad when even the index in the category that it's compared to went down almost 15%. So again, it's that sort of getting that similar return or that similar yield for a lower risk prospect so that we can be at a lower risk profile ourselves, but still getting decent returns out there in the market. What? This one here? Yeah. Yeah, so this is a really nice graph to use, and I can also at some point pull a report for the portfolio when I get into the advisor workstation. But here we can see the red is the index, the yellow is the category, and the blue is our investment. Now we've got two different axes on which we're looking. This one here on the bottom, this will be standard deviation, so that's our measurement of risk. And then on the left is our total return percentage. So over the period of time, how much has it returned and how high was the standard deviation? If we're looking here, we can see that the index and the category have a standard deviation closer to 11.5, 12%, and return barely above 1%, maybe 2%, versus our VRP here has a standard deviation significantly lower, closer to 8%, like we saw up there. Yeah, 8 exactly. But it's returning above 3%, closer to 5, maybe around 4. So we're getting a significant reduction in volatility, but actually an improvement in return. So that's something we really, really like to see. If you can get less standard deviation and more return, why would you not pick this investment?
That's going to be as far back risk as
Exactly.
and so to be in that top quarter,
Yeah.
that's phenomenal.
Yeah, basically what you want to see is you can also see a graph like this for all of your investments in your portfolio for your holdings with Morningstar. It's a really useful report that I'll get one of these days. I just didn't want to bring it with all the disclosures today. But you want to see that if you're further down here, we can accept less risk. But the further we move out, we want that curve to just go straight skyward. And anything that sits below it is just not worth holding. If I have something that has a 17% standard deviation, but I return 1% or 2% versus something else like this where I can have half the risk and quadruple the return, there's no reason not to swap a holding like that. So that's something.
The upside. Yeah, sacrifice a little bit and risk a little.
Yeah, so you will definitely sacrifice some upside potential when you're getting less volatile, just because the volatility is essentially what we want. We want to know that it's going to be moving up and down over time, but around a positive average. Like we want that average to just be consistently moving up. We want that channel to be pointing upwards versus just pointing to the side or pointing down, where, if I'm getting high risk, I want high return.
Yes.
That's the whole reason I'm taking the high risk.
Yeah.
So it's kind of balancing those factors and comparing them versus each other. That's why picking the right funds is important. Not because you're going to do better than everybody else, but because you want to make sure that for whatever level of risk you're taking, you're getting the best possible collection of securities with the least risk that you can take while still satisfying your goals, but getting the best possible return for that level of risk. That's where all of this really comes down to. It's not performing better than everybody else. It's performing better for the same unit of risk. Like if I can do better at less risk, that's what I want. That's the ideal.
That's why you won't see this on here. But for this fund to be much higher return than a lot of this risk, that says something about me. Things that don't give us here. Nice to have less risk. Almost the same receiver, but to have this one a higher return.
Yeah, absolutely. Let's see what else we got. We can also look at something like our all world. So we can see this expense ratio is low. Also, it says US fund formed, but the whole point is that it's not US. So I don't know why it says that. But if we look at something like risk, we can see here that it's decently more aggressive. You can see that portfolio risk score jumps up a bunch and puts us into the aggressive category. But still, compared to its category, For the last 3 years, the risk is below average. I'm curious, we go to 5 years, do we get the same story? We do. And for 10, we get the same story too. It's not by very much, it's by a very small little amount, but it is there. You can see that the index is actually doing pretty well. I'm curious what index that is, but you can see that it's slightly less volatile than its category and returning slightly, just a little bit more, which is what we want. Yeah, I think it is an index fund.
Yeah, so if.
Yeah, exactly. But there's just little bits of difference are nice. Just don't know if we have any other active ones to look at. We can look at this one.
XLK.
Oh, XLK. Okay. Yeah, yeah, those tech funds will do that for sure. Sector funds, standard deviation of 23. We bump it up to 10 years, still almost 20%. But you can probably a lot of similar stuff that we're used to seeing. Yeah. Pretty much, yeah. There'll be a lot of stuff that's very similar. The allocations of these might be a little bit different than S&P, but yeah, you'll see a lot of similar names. Yeah, for the top few, for sure.
Now, say, it's not.
Yeah. 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 Oh, speaking of which, that was one of the other ones I wanted to look at. Was JEPI. This is that derivative income fund that I was talking about, where you can see the SEC yield is at like 8%. And I think the reason for that is, it's one of the reasons that yield on this fund can change pretty dramatically is based on the prices of the contracts that they're selling. When you have an option contract on something, let's just say we're doing it on an S&P ETF, because you can do that. If you want to buy a call option, the more that the sentiment agrees with the market going up, the more expensive the call option is going to be, because you're paying for the ability to buy at a specific price. Now, if that price is below market value, it's going to be pretty high. But even if it's higher and everybody expects that it's going to jump above that market price, people are just they're going to be there throwing their money at that call option to spend more. So when you have the idea that the market is going to continue going upwards, you'll see the yield on this fund increase because they're selling more expensive options to the people who are betting on upward momentum. But then as things start to get bearish, you'll notice that the yield will probably dramatically drop off and it will get closer to 8, 7, maybe even 5. I'm not sure exactly how that's calculated, but I'm sure that if we see the market start to slide, we'll see the yield on this decrease as well. But it is still something that you can take. And if you're taking these distributions, like the dividend distributions to cash, it's a great opportunity to hold something like this. And even when things start coming down, you take that yield, dump it into your S&P fund, dump it into your growth fund, things like that. And then there's all right, first I want to look at the risk. I'm actually curious. Yeah, so this is kind of put at moderate because it's those options contracts kind of buffer the risk a little bit. They bring it down. It's also not straight up an S&P fund, so it's a little bit less risk than that. But you're getting a standard deviation of like 11%, which is pretty decent. And for the index, for the category, it's doing pretty well. Lower standard deviation, strong return.
Although the stocks will get bottom buying the stocks, but if it's flat, getting 80%, the market falls, it drops in that.
Yeah.
I don't sell it. Even to the back of the somebody will buy the stock.
Yeah.
Stocks to the sector. They're not going to think.
Yeah. Yeah, that would be an interesting idea to actually kind of do that within your own portfolios. If you can have an advisor or something that is willing to sell those out of the money call options on stock that you're holding, that could be a way to generate some income without wanting to, get rid of the stocks. Exactly.
Just don't sell them.
Yeah, there's an interesting strategy that I saw going around for a while when the stock market was kind of a little bit flat. It was a little bit of volatility, but it wasn't roaring higher. It wasn't falling incredibly dramatically lower. There's this strategy called the wheel strategy, where basically what you do is you start with your bundle of cash and then you sell put options on certain stocks. You sell them, you sell them, you sell them until finally you get assigned and you have to buy the stock. And now you've bought the stock, and you turn around, you start selling call options on them, and you sell until the stock gets called away from you. And you just start the whole process over and over again. You just keep going back and forth, selling the puts and then selling the calls. Overall, those growth returns will be basically nothing, but the hope is that you're generating lots of income in the meantime. The strategy works the best if things move nicely sideways, because if you're selling call options, you don't want the stock to suddenly triple in value. And now you go, well, if I just held that, I would have beat out my returns for the last 5 years. But you're just hoping that it kind of stays sideways so you can continue generating that yield off the investment. That's kind of the idea. So that's an interesting thing that we've done. Like just like not going too high, not going too low. Selling options for income always works best when volatility is low. But that also means that the options are not worth very much. So they're selling for very low prices. It's a complicated strategy that you have to be very nimble to do well. And I don't know if I've seen any long-term, like strong benefits of a strategy like that. And I'm curious if there's actually any ETFs that would do something like that, that would circle back around. Because I know obviously we have JEPI here, and then we also have another one called PUTW, which is essentially the opposite of JEPI, where JEPI writes call options, PUTW writes put options. So just the complete opposite, where they're selling puts in order to, this would be essentially you would never get assigned if the stock market continues to rise, but as soon as it starts to fall, you'll see the yield on this fund jump, but the overall returns will be kind of low as well with the capital appreciation.
Its value
Mhm.
maybe bought away or if you sold it at a loss, but if you didn't, you're able to cash in on a lot of yield.
Yeah.
It's less appreciation.
Mhm.
If they don't want to get sold, yeah, hold it.
Yeah. Yeah, pretty much. But again, like you won't quite feel the same. I mean, you'd have to be actively doing that yourself if you had individual stocks you wanted to do that on.
Well, next question. If I bought that and I never sold it in the rest, market up a lot, if I just held it and I spent all the 8% and beat my beneficiary in the share, they wait for that. But if I don't sell any of the rest, I need to lose them a lot.
No, not really, or at least you shouldn't. But again, you have to remember that the growth aspect is very minimal,
Right.
because if you see a strong correction, it's not going to be able to make it all the way back up. With dividends, sure, it might eventually recover, but if you saw that drop, if you really lost a lot of value, you might as well just buy the S&P and like wait for it to come back and then get to a point where the market feels a little bit more stable, switch back over. It's just something you have to be really active with.
It's kind of like buying rent, buying place and Europe. Well, if the value of the house goes up and you buy it away from, I didn't lose money, but I lost the appreciation because they bought the appreciation. And it does actually appreciate that. I got my money and you got the house.
Yep. All right, well, that brings us a couple minutes past our time, but I hope this was helpful for building your portfolio and gives you a couple ideas of what you can do moving forward. And if you have any questions, as always, we're here for a little bit, and I hope you learned something new.
Well,
Examples.
this